Students, this is Professor Brown. I'm going to go over the accounting cycle, which is what you should have learned by now as you study chapters 1 through 4. This is what it all covers. It all boils down to what you learn in chapter 1, the accounting equation. Assets equal liability plus stockholders' equity. Stockholders' equity being made up of two things: your common stock and your retained earnings. Retained earnings, therefore, being made up of the dividends that you paid out, your which are subtracted, revenue that you earned, and the expenses that you incurred. So once you combine those, you get what your retained earnings was. Plus, you're going to have a beginning, let me put this in parentheses, a beginning to get your ending balance in retained earnings. Compared with these things, adding to your stock, your common stock, will give you your ending balance and retained earnings, which goes on your balance sheet. So this is what your balance sheet is all about. This is why it all ties together. In order to understand everything else, you have to understand the accounting equation, because all of your journal entries and everything else applies to this. Another review, like I already did in the video that you should have watched, is dead coil. Dead coil reminds you of, this is a T account. It reminds you of debits on the left, credits on the right. And this reminds you of the vocabulary word that you should now know: normal balances. It is the side of the account that increases. So your expenses, your assets, and your dividends will increase with the debit. Your owner's equity, which is the same as stockholders' equity, which is made up of common stock and retained earnings, will both have a credit. Your I, which is another word for income, another word for revenue, will also have a credit balance. And then your liabilities will have a credit balance. So with that being said, you have to understand the normal balances in order to journalize. Okay? So study those. If this doesn't make sense to you, you use what works for you, but these are the rules. In your book, it gives you in Exhibit 5 the documents or the forms that you're using. So you're using a journal. Using a journal to journalize. What are you journalizing? The debit and credit accounts, names, and dollar amounts to record the transaction. So you have a date on the journal. You have a description on the journal. You have what they call a post reference, which all of these are vocabulary words and you need to look them up. And you have a debit and you have a credit column. You need to ask the questions that you don't understand. I can't make assumptions. So, for example, the example they give you in here, and actually I'm going to do a different example than what's in Exhibit 5. I'm going to do one that is one of the common ones listed in Exhibit 4 that you guys always get wrong. Services provided on account. When services are provided on account, that means that the customer came in, you provided a service for them, and you sent them a bill. The bill is then posted to what we call accounts receivable. Accounts receivable is an asset. And I'm going to use the date of December 1st. And so because it is an asset, it will be the accounts receivable that you debit. And let's say that it is for the $2,400. And this, again, is just a made-up example. And because you earned it for providing a service, that means you earned some revenue. So revenue will be indented. It will be credit for $2,400. That's why it's indented. And then this post-reference column is done after you have posted. So this is the journal entry. You wrote the debit. You wrote the credit. You wrote the dollar amounts. Now you go to the ledger, the general ledger. All these are vocabulary words. You go to the general ledger. You look for these accounts. Accounts receivable is under the assets, which are always listed first because everything is listed by the accounting equation. It's typically the second one. So you go into accounts receivable and you look for it. It's also going to be set up as a mini spreadsheet. It's going to have a date. It's going to have item number. And again, I covered all this in the lecture. Has a post reference, which you need to understand what they are. And it has 2 debit and credit columns. It clearly identifies above the last one, this is for your balance. Okay. I'm just going to draw the lines along because I'm also going to put this other account, which is the revenue. And I'm just going to put the word revenue because revenue is generic. It is a category for fees earned, for commissions, for sales, for everything else we talked about yesterday, dry cleaning, whatever the revenue is. And it's also going to have the date, the item, the post reference, the debit and credit, debit and credit. So these are 2 different ledgers and 2 different sections of your general ledger. So if you've already had money in here, so let's say, for example, you already had a beginning balance of 1,000 in here, meaning that you already have credited a customer. And I'm going to change colors. You have 1,000 in here that you've already credited a customer. Let's say that you already have some revenue in here of 2,000. Okay. We're going to go and we're going to post, which is a vocabulary word, this transaction. So we have a debit to accounts receivable. So we're going to come down here to accounts receivable. We're going to skip the line because this line is your beginning balance. And we're going to put 12.1 and we're going to put nothing here because it's already written in detail up there. And typically accounts receivable is account number 12. But we're going to put journal page 1, which this is typically page 1 because we just started. And up here we're going to put 12 because this is typically number 12. And then we're going to put the amount of the debit, 2,400. And we're going to calculate a new balance, which means the new balance is 3,400. This is what the rules of debit and credit means. A debit will increase an account with the normal balance of a debit. A credit will decrease an account with the normal balance of a credit. So you have to practice debits and credits in order for it to make sense. For this revenue account, again, this was the beginning balance for them. So we're putting 12.1. We put nothing here because the details are there. It came from page 1 of the journal. We have a credit of 2,400. We already had 2,000 in here. So we're going to increase this to what? 4,400. This is our balance. And so now you go back up here. This is typically account number 41, and you're going to put 41. This is called cross-referencing. So you need to look up the vocabulary and study them as I've given them to you already on the chapter focus. The chapter focus gives you everything you need. You guys just aren't practicing. So make sure that you practice. You have to take out pen and paper just like I'm doing and not just simply watch. You have to practice to understand. So now this information that's listed here, if I were done for the month, this would be my ending balance, 3,400 for my accounts receivable, and 4,400 would be my ending balance for revenue. These are the amounts that I would post for each of the accounts when you finish all the transactions. Your ending balance would be the amount that goes to the trial balance. After you create the trial balance, which the trial balance, as your book tells you, is just another listing. You have your debits, you have your credits. And all these accounts over here are listed according to what? The accounting equation. You list the assets, you list the liabilities, stockholders' equity, and everything. Again, this is covered in the book, and I've covered. I'm just doing a review. So here's your trial balance. It also has a heading, just like your financial statements. So you need to go back and read that. Nothing that I've covered in these videos is anything new that I haven't already covered. Just understand that. So from the trial balance, you get into chapter 3 where you have to do your adjusting journal entries. Why are you doing this? Because these balances aren't accurate. You have to adjust what happened during the month that could heavily impact the financial statement. So on your chapter focus, I give you the exercises that say effect of omitting. You need to work through those because you need to fully understand what happens when you don't include an adjustment. Exhibit 6 gives you a whole overview of the adjusting process and how to record the transactions. It tells you what happened before and what you need to do after. So you're always going to adjust your, you have your accrued, you have deferrals and deferrals and accruals. So deferrals mean delay, accruals mean you've accumulated. What's that? Accruals. And you have, in addition to this, depreciation. So your delays, the things that you're delaying, are your unearned revenue, which is a vocabulary word. This means you've already earned the revenue that gave you the cash, just like you would do an attorney. You give them a cash up front and they give you the service after the fact. So it's a liability because they owe you the work. I've already discussed that in the video, so I'm not going any further. Then you have your prepaid expenses. This is like your supplies, like your prepaid insurance, like your prepaid rent, all the other examples that you have. You have to adjust for these. So when you pay the rent, you have to adjust. When they do some work, you have to adjust. You're adjusting the balance that you posted up here in the trial balance. Down here, you could have some accrued revenue and some accrued expenses that you did not record. So in other words, you could have some revenue that you billed the customer, that you need to bill the customer for, that you did not. You could have some expenses where the bill came in after the end of the month and you need to add them. Otherwise, your balances and your financial statements are going to be off. So the other adjusting entry is depreciation. It doesn't fall under deferrals or accruals. It is just its own adjustment. So you're adjusting for the use of your fixed assets, which by now you should know what fixed assets are. And they tell you in the book specifically, you are debiting depreciation expense and accumulated depreciation, which is a contra asset. You need to look that up and get a good understanding of that. You will not understand chapter 3 and adjusting entries unless you do them. So you're going to post them to the journal, the same journal that you had already been using. You're going to then post to the ledgers, the same ledgers. You're going to get new balances. After you get these new balances, you'll have an adjusted trial balance, similar to this one, but the amounts will be more. Then you can create your financial statements, starting with what? The income statement, then moving to what? The statement of stockholders' equity, and then moving to what? The balance sheet, and then what? The statement of cash flows. They go in that order. They don't change. It's been like that through the whole book from chapter 1. After you do your financial statements, then you have chapter 4, which you do your closing entry, closing journal entries. They're going to be on the same journal, and then the same ledgers. And then you'll have what the book calls a post-closing trial balance. What are you closing? Your red accounts, which I reminded you of yesterday. Your red accounts, your revenue, your expenses, and your dividend. What are you closing them to? Retained earnings. Why? Because this is a permanent account and these are temporary accounts. Those are other vocabulary words. So if you haven't heard anything else I said, you should have heard vocabulary a million times in everything that I talk about. It is the key, people. Memorize vocabulary. Memorize the rules. Practice applying it. These are the only two secrets to accounting. Memorizing the vocabulary so that you understand what the words are telling you to do. Practicing by applying what you have learned so that you know how to work it out. There's no other secret. So This should be the conclusion of your understanding, hopefully, of the accounting cycle. It ends in chapter 4 with the closing journal entries. You start a new beginning of the month or period, fiscal period, with the balances on this post closing trial balance, which is why you create it. Then the month begins again.